I am not an investor in HDFC. That's what I was thinking because I could not see any HDFC stock in my Demat account. Then I remembered that I have invested into ELSS mutual funds and index funds as well. No fund manager can imagine running a fund without HDFC in it. It's like making butter chicken without the butter. Then there are the futures and options guys whose obsession with the Bank Nifty makes them spend half of their lives staring at the Bank Nifty's candlesticks. After this merger, the market capitalization of HDFC Bank will be around 15 lakh crore rupees, which means HDFC is going to dominate the indices. The weightage of HDFC Bank in the Bank Nifty will go up to 46%, but due to a rule, it will be capped at 33%. So it doesn't matter whether you are a mutual fund investor or a believer in Bhao Bhagwan Che. HDFC is going to affect everyone. The management has claimed that the merged entity will grow so fast that they are going to create a new HDFC Bank every 4 years. We are going to investigate that claim. In the last 15 years, the HDFC Bank stock has given a CAGR returns of 20% against the Nifty 50's 14%. If this merger really creates a new HDFC Bank every 4 years, how much alpha can it generate over the Nifty 50 in future? Can it generate a 20% CAGR? To get a rough idea, let me explain that at 14% CAGR, an investment of 10 lakh rupees becomes 71 lakhs in 15 years. But at 20% CAGR, the same investment becomes more than 1.5 crores in 15 years. That is more than doubling your wealth just by picking the right stock. The question is, can HDFC do it? Please stay tuned to find out. And if you want to help this channel continue making more videos like this one, please consider subscribing. Namaste and welcome to Retail Investing. This mega merger will make HDFC the fourth largest bank in the world after JP Morgan and Chase, Industrial and Commercial Bank of China, and the Bank of America. Post-merger, the shareholding pattern will be a little complicated. HDFC Bank will be completely owned by public shareholders, which will also include the existing shareholders of HDFC Limited. The existing shareholders of HDFC Limited will own 41% of HDFC Bank. Sounds complicated? In simple terms, if you are a shareholder of HDFC Limited, for every 25 shares of HDFC Limited you hold, you will get 42 shares of HDFC Bank. That's what the calculation says. After the merger, companies like HDFC Securities, HDFC Asset Management Company, HDFC Ergo General Insurance, HDFC Life Insurance would become subsidiaries of HDFC Bank. So the share price of HDFC Bank will be affected by the performance of all these companies. And it looks like the deciding factor behind the performance of the stock will be home loans. So let's have a look at the home loan market. According to a study by Credit Bureau, CRIF Highmark Limited, the size of the home loan market is roughly 22.6 lakh crores. Out of this, the banking sector controls 60% and the housing finance companies like HDFC Limited control 38%. Now here is the interesting part. Out of the market share controlled by all housing finance companies, HDFC Limited alone controlled roughly 50%. The Real Estate Act of 2016 called RERA totally changed the housing market in India. Due to greater transparency enforced by that law, real estate prices corrected a lot and inventories of real estate companies came down, which means the number of unsold flats came down. At the same time, income levels have been rising fast, which has made home loan EMIs a smaller percentage of a person's income. The desire to own better homes is at an all-time high. It is expected that housing is going to be a major driver of growth for India's GDP in the next decade. It looks like HDFC plans to capitalize on that like no other bank. The home loan customers of HDFC Bank typically have 5 to 7 times the deposits that other retail customers have in the bank. So it's logical for HDFC to focus on these high-value customers. Until now, HDFC Limited, which was a housing finance company, was dealing with the home loans. These home loans were sold by HDFC Bank, for which HDFC Limited had to pay a fee. About 70% customers of HDFC Limited did not take banking services from HDFC Bank, and only 2% of HDFC Bank's clients owned a product of HDFC Limited. So this merger is going to create massive cross-selling opportunities for the HDFC group. As per data from financial year 2021, HDFC's overall share in housing loans was 31%, second only to State Bank of India. So after this merger, three things look obvious. The housing finance companies are expected to lose a lot of market share in the house loan category, and the banking sector is going to gain market share in that category. The future growth and profit margins of the housing finance companies will be affected. Banks have a very large balance sheet compared to the housing finance companies. This gives the banks access to low-cost capital. Housing finance companies cannot compete with that. The housing finance companies may have to move towards developer loans from retail loans. This creates asset quality risks. Let me explain how. In case of developer loans, a single company takes a huge loan. This creates risk for the lender because if that single company defaults due to some challenges in its business, the lender loses its asset. Something like that happened with Yes Bank. Retail home loans are much safer assets for banks because the borrowers have fixed salaries and the loans are diversified among many borrowers. After this merger, as a retail investor, I would not consider investing into any housing finance company. In a recent letter to his colleagues, the CEO and Managing Director of HDFC Bank said, "The vision that we have laid out for ourselves in reimagining our technology architecture will make us a technology company which is into banking. You will be proud of the same when it gets unveiled over the next 3 years." From this statement, it looks like HDFC has planned massive disruptions not only in the banking industry, but also in industries like housing finance, insurance, and NBFC. As per the management's plans, the new entity after the merger will grow at unprecedented speeds and will create a new HDFC Bank every 4 years. Guys, the market cap of HDFC Bank before the merger was around 9 lakh crore rupees. It was already one of the largest companies in the country. The management has plans to add 1,500 to 2,000 branches every year to reach every corner of the country. That these branches will be very small in size and will be called phygital relationship centers. That is the kind of a liability franchise the management plans to create. This merger will create a massive balance sheet for the bank of around 25.6 lakh crore rupees. It is only the State Bank of India which has a larger balance sheet of 45.3 lakh crore rupees. What this large balance sheet is going to do is give HDFC access to very low-cost funds for lending, and the technology play will give them access to a huge customer base without any increase in the cost of acquiring those customers. The management claims that it will be the lowest ever cost to revenue of any housing finance institution in the entire world. It is a very simple concept in investing that if the cost of revenues go down and the volumes of revenues go up, it's a recipe for a multi-bagger. But can they succeed in doing that? I think they are going to succeed at keeping the cost of revenues down because they are going to leverage the digital infrastructure built by the government. As of now, 40% of all global digital transactions happen in India. These transactions are extremely low cost and are borne by the government. The banks did not spend money to create Aadhaar-linked bank accounts and then UPI transactions happening through those accounts. And the banks are not spending either to build the internet infrastructure for which there are companies like Reliance. I think this is the reason why the management claims that it will be the lowest ever cost to revenue in the entire world. And what about increasing revenue volumes? Well, almost 50% of the Indian population is under the age of 35. The rise in usage of internet and social media have increased the aspirations of citizens all across the country to an all-time high. People from small cities and towns now aspire to build new homes. This will also increase the demand for consumer durables, things like air conditioners, refrigerators, and TVs. All these consumer durables are usually financed. That's why the HDFC management expects growth in geometric proportions over the next decade. As per my understanding, this merger could create disruptions in the NBFC industry as well. It could affect the growth of companies like Bajaj Finance. Earlier, NBFCs were enjoying a regulatory arbitrage over banks, which basically means that the rules for lending and maintaining reserves for the NBFCs were not as strict as they were for the banks. But since the collapse of NBFCs like Reliance Capital and Diwan Housing Finance, that arbitrage is almost gone. So now it's becoming easier for banks to finance the purchase of things like TVs and ACs. A home loan customer is a high value customer because they have more purchasing power. So HDFC is going to acquire a home loan customer, and after they buy the home, they will be offered to get the home insured by HDFC Ergo. Then they will be offered loans to purchase consumer durables like TVs and ACs. HDFC AMC will offer them to invest into mutual fund SIPs, and HDFC credit cards are also going to be offered. The potential of successfully selling all these things to a home loan customer is quite high because of their purchasing power, and Bajaj Finance cannot acquire a high value customer like a home loan customer. So am I going to buy the stock? Probably not, because I like to collect small cap stocks in my Demat account for multi-bagger returns, and I already own a lot of HDFC through the mutual funds. Good performance by HDFC will make these mutual funds give better returns. Ace investor Mr. Saurabh Mukherjee of Marcellus, whom I always follow, is probably going to be right in his assessment that HDFC is going to become a dominant franchise and a consistent compounder. And guys, don't forget that Mr. Mukherjee is invested in the HDFC stock, his family members are invested in it, and most importantly, 10,000 clients of Marcellus are invested in it. The question is, are you going to invest in it? Please type in the comment section. I hope you enjoyed the video and got something valuable from it. Thank you very much for watching, and we shall meet again. Have a nice day.